Good morning. It's Thursday, the 28th of November, and this is Govindraj, Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take: the rich getting richer is not helping. India can't rely on wealthy individuals to drive growth and expect the overall economy to improve. Acharya, former Deputy Governor of the Reserve Bank of India, had said at a conference in Mumbai in September that I had the opportunity to attend. We can't be pumping our growth through the rich and expect that the economy as a whole will do better, he had said, adding that when the rich keep getting wealthier and wealthier, they have a savings problem. Acharya, who is the CV Star Professor of Economics in the Department of Finance at the New York University's Stern School of Business, NYU Stern, had pointed out that as the rich get richer, they look for financial assets to invest in. Now, in the case of India, the rich can't invest their money outside of the country that easily. So it has to chase the limited financial assets within the country, and a lot of prices in that space have gone up, but it doesn't boost India's consumption, he had said. Now, remember, this was in September. The professor also touched upon the fact that rural consumption and investments had weakened after the COVID-19 pandemic. He was also likely referring to the post-pandemic spending surge that had already started to show early signs of slowdown and which are far more visible now as we look back at the latest quarterly results of consumer product companies, among others. So the latest HSBC Global Entrepreneurship Wealth Report 2024 reminded me of Acharya's words. So here's the good and bad news. The good news is that Indian entrepreneurs are generating wealth, including from stock sales in a booming stock market or from exits to venture capital investors. They've also generated wealth the old-fashioned way, which is from businesses that have done well and been perhaps lifted up by the sheer consumer-led growth as well as public spending that we've seen accelerate in recent years. So here's the flip side, maybe not bad news. Rich Indian entrepreneurs are using their wealth predominantly for investing in stocks, bonds, and real estate, the HSBC's wealth report said. So their approach to wealth management is quite different from other markets or other countries, according to that report. According to the report, 82% of Indian entrepreneurs, those with at least $2 million worth of investable assets, prefer to invest in stocks, bonds, and real estate, which is the highest percentage amongst business owners in 10 international markets at 51%. Investments in other businesses at 41% and precious metals and stones 25% are other investment avenues for wealthy Indian entrepreneurs. The results are based on a sample of about 1,800 high net worth business owners with at least $2 million worth of investable assets who chose to take part in the survey. Here are some other interesting insights on the spending spree India's wealthy are on as compared to other countries. 6 out of 10 Indian wealthy business owners allocate personal wealth to real estate for their own use compared to 1 in 2 globally. They are also more likely to spend money on luxury goods, that's 56% compared to a global average of 40%, and luxury experiences, that's 44% compared to a global average of 35%. While the Indian market remains an attractive place to do business, with 75% of the entrepreneurs operating domestically, many of them are looking to move abroad. And more on that in a moment. Most of these individuals said that their aim is to grow their wealth and to improve their personal and family health and to ensure financial freedom. Enjoying a luxury lifestyle is cited by 44% compared to a global average of 32%. However, they have a strong sense of duty and 9 of 10 agree that they need to take action to make a positive impact on society. So, while the report is not a sweeping study of all wealth created and where it flowed, it surely does reinforce the point that there is a sustained divergence in the economy. Since most wealth continues to go into stocks, bonds, or back into them, it is keeping markets and domestic buying strong, as is quite evident from the movements in the last 2 months. But it also means that there is a mismatch between supply and good quality investment opportunities because most of them are highly priced. And when I say supply, I mean supply of capital. On the other hand, as we can see, quarterly results of most consumer product companies are reflecting a stagnation of sorts in consumption, if not slowdown, which also reinforces the fact that wealth created is not directly flowing to the people who could actually spend it and thus drive up consumption and economic growth, something that we've discussed in the past as well. Not that it would happen immediately, but real estate is seeing considerable investments, particularly in higher priced properties. Now, this obviously has a trickle-down effect into the construction industry and the over 71 million people who work in it, which is also important because construction is the second largest employer in India. This also accentuates another mismatch that all those who are trying to buy homes to live in are not able to do so this time around as well. We've already seen the slowdown in affordable housing because people are unable to even put down the money for loans. Interestingly, more than half of those surveyed individuals said that they were looking to move to other countries in the next 12 months, and even others were looking to move their personal wealth outside the country. Their biggest worries were corruption, inflation, and taxation. In that, perhaps, whether rich or not rich, there is unanimity in thought. And that brings us to the top themes of the day. The markets were steady again. Where are the stock markets headed as the year ends? Honda to launch electric two-wheelers and the emergence of a multi-fuel market. Cyber scams cross 11,000 crores this year.
This is a core report with Govindraj Ethiraj.
The markets stabilized once again. So the stock market closed higher on Wednesday thanks somewhat to a rebound in Adani Group stocks after its subsidiary Adani Green said that its key officials had not been charged with violations of the United States Foreign Corrupt Practices Act in last week's indictment. The benchmark indices, the Sensex and the Nifty, were up. The Sensex closed up 230 points at 80,234 and the NSE Nifty 50 settled at 24,274, up 80 points or 0.33%. On Wall Street on Wednesday morning, the S&P 500 was lower as traders waited for the Federal Reserve's latest inflation gauge. The broad market was down, but the Nasdaq Composite was also down. The Dow Jones Industrial Average rose about 99 points and putting it on course for yet another record close. That's Wednesday, according to the CNBC. How are the markets behaving at the end of the year? So that might seem like an odd question to ask, but at the end of the year or close to it is usually a good time to look back at what trends have driven markets so far, what's different, and what could change potentially looking ahead, including in the way institutional investors, both domestic and overseas, could behave. We have several conversations coming up in this regard, and last night I spoke to Gaurang Shah, head investment strategist, Geojit Securities, based out of Mumbai, and I began by asking him what trends he had been seeing until now.
I think what happened over the last maybe about a month and a half, or a little bit more than that, starting from October 1st, the sell side numbers coming in from the FI and the markets correcting a little bit over 10%. And then we've seen some kind of stability coming to the market. And then I believe the Q2 earnings was not so exciting. There were disappointments and dark spots. And I think that added to the rich valuation that the market was drawing to. Fast forward to the current and the future outlook, year end December 24. The sense is that point number one, large aggressive selling that was happening from the FIs has kind of withdrawn a little bit. I think yesterday or something, there were buyers also. So the pressure on the markets to head much lower from here, that kind of a thought process can be put to rest because very soon, possibly by 15th of December, you will see Christmas holiday and year end starting for the FIs. That could possibly bring down the volatility and the correction that we've been seeing. Could have some 1 odd days of selling till that time. That cannot be ruled out. But more importantly, Govind, I think the market should stabilize a little bit. Despite the fact that last week, Friday, we had a 1900 point rally, followed up by Monday, and then Tuesday, we had a little bit of choppiness. Today, again, market was a little bit choppy. But even in this kind of a scenario, the India Volatility Index was at an elevated level. It was at 16, it has settled at 14.5, if I'm not mistaken, today. But it needs to come down for the stability to come into the market. So I think gradually, by the time we see the year end and say goodbye to 24, I think we should be in a position to recover quite a bit of lost ground. One more thing, Govind, this late afternoon or something, we heard some announcement that Israel is agreeing to ceasefire for the situation in the Middle East. This is also added to the sentiment. Don't know what shape and what form it will take. And I hope if they stick to the words that they are saying, then there could be some kind of more sanity in the markets.
Right. I'm going to come to sectors and how that looks. But before that, if you were to contrast this period, which is the end of the calendar year, with previous years, would you say it's somewhat different, dramatically different?
So it is little bit, different because what has disappointed Govind most is the Q2 earnings. Let me say this also. It's not like the third and the fourth quarter is going to be a disaster. Whatever the verbatim that has been given by some of the, leading companies which form the Sensex and the Nifty, that commentary is quite promising. And the commentary also says that recovery will come through. So on the earnings front, I think third and fourth quarter delivers will do well. If you have to compare this time and possibly a year last or maybe before, and of course the FI selling, because we had not seen a number like 1,40,000 crore, correct me if I'm wrong, Govind, from the FIs. whatever we've seen. And I think the similar match was there from the domestic institution, which was a good point, Govind. So this is a bright spot that I would want to draw in a scenario when FIs have sold maybe more than a lakh and a 40,000 crore. Domestic guys have bought, and I think the liquidity is plenty with the domestic guys. So this is a little bit different than what we've seen in the past time. And one more thing, retail investors put in record number of SIP in the October month, while the FIs sold a large chunk of their investments.
Right. So strong retail supply continues. Now, on sectors, is there anything that stands out again as we head into end of calendar 24 in terms of either performance or outperformance, and the opposite as well?
In terms of performance, go with the positive on IT, pharma, thanks to whatever has happened in the United States in form of the 47th president taking his chair very soon and being sworn in. I think IT pharma should be in the spotlight for all the good reason. Banking and finance, I think they should do well. Power is something, power and cap goods engineering, Govind, we feel that these two sectors will also do well. And one sector that I think will possibly tend to recover the lost ground that we've seen in the last 6-8 months is the defense sector. I think valuations have now come to an attractive level from a long-term investment point of view.
So when you say they recovered lost ground, you're saying that their businesses are still intact. It's only the valuation perception that had perhaps maybe inflated and now it's sort of correcting.
You're absolutely spot on, Govind. I think if you look at the order book even for the second quarter of most of the defense-related companies, I think they stand much better than what they were at Q1. And whatever we have listened into and read into the order book that these defense companies got, I think this particular sector is positioning itself for a long-term growth story.
Gaurang, thank you so much for joining me.
Thank you, Govind. I wish you all the very best. Thank you so much.
Cyber scams are growing. As payment systems get more ubiquitous and multi-layered, cyber frauds are increasing as well. India saw losses of 11,000 crore rupees due to cyber fraud during the first 9 months of the current year, according to data from the Indian Cybercrime Coordination Center, or I4C, under the Ministry of Home Affairs in the Government of India. Stock trading scams were the biggest culprit, with about 228,000 complaints and losses of about 4,636 crores. Investment scams were behind, with about 3,216 crore lost across 100,000 complaints. Another 1,600 crores were siphoned off through digital arrest frauds. We may have been hearing about them, involving 63,000 complaints, according to a report by the Indian Express. A lot of people, by the way, as you know, I'm sure, do not even complain. So the extent of damage or harm or money lost would be much higher than what we are seeing here. Some 1.2 million complaints of cyber fraud were nevertheless registered in 2024 alone. Apparently, some 45% of these cases originated from Southeast Asian countries like Cambodia, Myanmar, and Laos. Since 2021, some 3 million complaints have been logged, accounting for losses totaling about 28,000 crores. Honda enters electric scooters and focuses on trust. India's second largest two-wheeler maker, Honda Motorcycles, has announced an electric scooter that will hit the markets on the 1st of Jan. HMCI is the last major established two-wheeler player to enter the electric two-wheeler market. TVS Motors, Bajaj Auto, and Hero Motorcorp are already the top players in this market. Interestingly, it has positioned itself as a product you can trust, which is not surprising given the harm done to the market by other two-wheeler brands who did not seem to or have any real service network to back their product sales. The company's head of sales and marketing told reporters in Bangalore that the most important point was trust, because there was a lot of pain points currently for the EV customer in the market who were not really happy with the kind of products that were available. And even as it unveiled its first two e-scooters, that's a swappable battery run Activa E and its fixed battery run QC1. Honda has 6,000 sales and service touchpoints across India. Over 1,000 are main dealerships, which will be the first ones to be upgraded to handle EV sales and services, the company said. As we've been pointing out in the core, the one thing that you could depend on legacy companies in the automotive space to do is to set up service networks which were somewhat matched with the sales of their products. Honda Motors also said that while the E2V, that's electric vehicle growth market, has slowed down a bit recently, the long-term outlook remains to be positive. However, they did clarify that electric vehicles are just one of the pathways to India achieving carbon neutrality, as other vehicles which run, for example, on biofuels or CNG, that's compressed natural gas, will also play a significant role. And that brings us to the interesting part, because Bajaj's CNG two-wheeler, Freedom 125, is also doing well. Analysts are already projecting CNG volumes for Bajaj two-wheelers to be significant and expect sales this year to hit about 6% of its domestic two-wheeler sales. And in 25-26, that's the next year, it go up to 21%, with the company selling over 700,000 CNG bikes. These are according to some analysts and not the company. But there are two important takeaways from this. First, the mature players are winning back and growing market share in electrics because they are backed by a good and dependable service network in India, which is critical. And vehicles cannot be thrown away, or rather sold like throw them away mobile phones. Second is the battle of the fuels. While electric is one way to go, it looks likely that manufacturers with the ability to offer hybrid variations could score. Now, this is something that pure electric vehicle manufacturers may not be ready for, or it would take them time to adapt. Electric vehicles are inherently simple to manufacture and or can be imported and assembled quite easily, as has been the case in the past. Not so much with two-wheelers or other vehicles with multiple fuel systems, including, let's say, compressed natural gas. Remember, hybrid cars are now selling faster than electric cars in India. So the two-wheeler market is clearly poised for interesting times and much welcome consolidation, as well as, of course, better products and servicing capability for demanding customers. Sanofi's evolutive vaccine facility. French pharmaceutical giant Sanofi on Wednesday opened a 800 million Singapore dollar, that's about 595 US dollars, evolutive vaccine facility, or EVF, in Singapore, the only such facility the company has outside of France. Now, this plant, known as Modulus, can apparently switch between making different vaccines or treatments in days compared to several weeks or months in conventional facilities, and can also be adapted to manufacture up to 4 vaccines or biopharmaceuticals simultaneously, according to CNBC. So this facility will be fully operational by mid-2026, and Sanofi said in a release that the facility holds the potential to significantly bolster pandemic preparedness, something that we've not really focused on in recent years, at least after COVID. Sanofi said that by establishing the groundwork for crucial production modules now, Modulus can ensure a swift and targeted response to any future health needs, including potential pandemics. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.